Looking at some of your favorites, and what do you have, 100 different issues in the portfolio?
In the one strategy we have 100. I think in the firm as a whole we have 200 or 300 because we have 7 or 8 different strategies.
You've mentioned Nestle's. You seem to love Nestle's.
I think conceptually I like Nestle. It's all about when you decide to buy it. But Nestle is one of the world's great companies. When you look at the free cash flow it generates, they do a little bit of everything in their allocation. Almost all the reinvestment or acquisitions that take place are tilted toward emerging markets because there's faster growth there. At the same time, they're able to increase the dividend every year and they have a healthy buyback ratio. So you basically have a growth rate of the underlying free cash flow there in that 8 to 10% area in our view. And in today's world with the valuation, that's an attractive holding to us.
So you get a twofer for it. You get the emerging markets without going in the emerging market stock market.
Right, and we feel for us, we would prefer to do that through what we call global champions. Now, what are global champions? Well, global champions are companies that essentially are large enough to reconfigure their resources. So if Nestle would decide to make chocolate in Poland instead of Switzerland, they can do that. And if they want to sell that chocolate in Vietnam and not China, they can do that. These entities happen to be lodged in geographies, but they're phenomenal economic entities themselves. And the ability to reconfigure your resources and alter where you sell your product is a fantastic advantage today.
Anheuser-Busch InBev.
Right. Anheuser-Busch InBev we've owned for a long time. I think it's probably one of the greatest managements in the world. They really know how to build a company. They have something like more than a dozen, I think it's 14 $1 billion brands in their product makeup. They are dominant in most of their local markets. They have lots of pricing power. And even though the cash yield is relatively low, it's 2.5% to 2.8%, between buybacks and debt paydowns, this has been a fantastic stock. So we continue to think Anheuser-Busch is going to do very well. People drink beer through thick and thin.
You like Microsoft.
We do like Microsoft.
Wallflower for
longer than I'd like to acknowledge. Most people think it is an obsolete business model, but it really isn't. And just referring to a note I have here, they're number 2 in search. They're one of the top 10 cloud providers. They have the leading game console, the Xbox, and they're the biggest provider of enterprise services. It has a 10% free cash flow yield, growing in double digits. So we think they actually are a good capital allocator. It's very low valuation. And you've just had the launch of Windows 8. It's going to be a lumpy launch in the sense that many aspects of it are truly revolutionary. We don't expect business to pick it up right away. But it is all going to be a plus. But we do think it is a very, very reasonably priced stock.
When you got in early on, Apple, where do you see that going? It's taken a real hit.
It has. I think Apple peaked something above 700, and at one point today or yesterday it was down around 535 or 540. So it's off 20 or 25%. Not an uncommon percentage decline for stocks. And when you look at the absolute dollar decline, it's large, but percentage is not. And I think that's been driven in part by a little more competition. The map issue, they fired a couple people. Tim Cook is not the visionary that Steve Jobs was, but he's sort of the right man for the job in terms of it is really making sure that your supply chain works. I would expect the fourth quarter to be extraordinarily good, and I would expect that stock to have a pretty good bounce from these current levels. Whether or not there's been a fundamental difference, there probably has to some extent. Trees don't grow to the sky, but it's really pretty cheap today. And you strip out the cash, it sells for less than 10 times earnings.
Another one you seem to like is Samsung.
We do like Samsung, fairly new to that in terms of we have not owned that in the past. It's debatable. My analyst thinks Samsung's phone is better than Apple's phone, but it doesn't have the apps and it doesn't have the cachet. On the other hand, if you look at the very colorful ads for Samsung, I find them to be just marvelous, where the young people are standing in line for as placeholders for the parents who are
Right.
about to buy the Apple phone. I think that's a fabulous ad. And Apple is taking market share in tablets and is taking serious market share in phones.
Daimler, do you still like that?
No, we parted company with Daimler. We feel the automobile industry, to me, particularly in Europe, a lot of that is China, and I think China is slowing. And it's a great company, but we parted company with that, just believing that final demand was going to slow, particularly in China, for the automobile companies.
Vodafone?
Vodafone is also run by excellent management. We continue to own Vodafone. They basically are a wireless provider with, again, we think, very much better management of capital allocation. We think it's probably worth something in the low 30s today. If you look at the dividends and the free cash flow generation, that will continue to go their way.
Touching Daimler again, what's their dividend yield now?
It's low. It's 1% or something like that.
So they've had a good run.
They've had a very good run, and I think most car companies sell at about 3.5 times cash flow, except for the premier companies like Daimler and BMW and a few of those. But we just think that whole consumer durable market is pretty saturated right now.
What other ones turn you on?
In terms of names, well, Rolls-Royce is one of my favorite companies. Now, they don't make cars anymore. They're made by they've licensed the name elsewhere. But Rolls-Royce is basically an engine replacement story. Once an engine is designed onto a plane, you have the replacement rights forever. And most of the new planes have one of those engines is designed into Rolls-Royce. It has a fairly low cash yield, but we think the free cash flow today is low also, but it should triple over the next 3 or 4 years as the R&D comes off and some of the capital spending comes off. It is truly one of the great business models of the world. Every time you're flying in a plane with a Rolls-Royce engine, every second that engine is turning over, it is feeding a computer on the ground. The data that they have on engines is just amazing.
Better than GE?
The GE engines, I'm sure, do the same thing, but it's basically an oligopoly between GE, United Technologies there as well with Pratt & Whitney, and you have Rolls. But it is, most of the new planes, we have a very large holding in what I would say are commercial aerospace. Now, you need the world to grow for that to work. It doesn't have to grow that fast, but the demand for planes and the demand for more fuel-efficient planes is quite high. And we would much rather play the engine companies than the airplane manufacturers. Although we do own both Boeing and another European company called Safran, which is an air supplier. But I would say Rolls-Royce is just an amazing company, and the stock market doesn't adequately discount that cash flow stream they have. The market tends to discount near cash flow streams very well, but far out cash flow streams not well enough. And so we feel that you have a substantial margin, multiple expansion possibility in Rolls-Royce. We've owned that for a couple of years. It's been a good stock, and we think there's more to come.
ETFs, are you still agnostic on them?
Definitely agnostic. There was an excellent article in the CFA Digest, which is the Chartered Financial Analyst Digest, some time ago, and it referred to ETFs as emerging threat funds. I love the article because they're a pain in the neck, and for us in some ways. There are a lot of issues surrounding many ETFs and their structure where you have counterparty risk. People aren't familiar with those. Some of the plain vanilla ones are fine. Many of the ones issued by Vanguard and BlackRock are fine. But you aren't getting individual company exposure. You may not want that. But they have a place in the world, but I certainly don't think they're a panacea to an actively managed portfolio where you hopefully have good security selection.
So they're not going to make that part of the industry a dinosaur?
No, I actually think that part of the industry will come back. The tricky part will be understanding why does the firm think it's going to win in a world where you have ETFs and index funds and so on. It only wins if you think the firm is good at understanding how businesses work. And to me, you have to look through the prism of a free cash model to understand how a business works. And even if, so you understand it, you have to like the business, then you have to deal with valuation, because if it isn't appropriately priced, you should move on. It's just not worth the valuation risk. So there's the identification of a good business and then the pricing of it.
Taking your model, why isn't there more M&A activity? Or is that?
That's a good question. I have said before, I thought this year you would see a lot of M&A because the growth in the economy has been slow. CEOs are asked to grow their business, and if you can't grow it organically, then doing it by M&A. I am surprised there hasn't been more. There's actually been a lot of small things going on, but I think a lot of it has to do with people don't know the rules. And I think until Washington is clear with its tax policies, I just think you're going to continue to have stagnation. There's a chart that we use in our quarterly report which shows a measure of economic uncertainties. And that economic uncertainty index is higher than it's been in 20 years. And uncertainty does not breed conviction when it comes to capital allocation.
Finally, looking at 2013, what do you think is going to be the biggest upside, and what's going to be the worst place to be? Best investment and the worst.
I think equities will beat bonds, but my caveat is we have to get growth. Europe is a mess, and Europe is going to have a recession. China is going to grow, but more slowly. The U.S. should be able to grow at a satisfactory rate, but Washington, frankly, is a nightmare for business. We have gridlock. We have essentially neutralized our ability to govern ourselves. And that's very unfortunate. I would guess that stocks will beat bonds. I think it's probably a single-digit world at best. And I think at some point, inflation will come into the system. The only way to solve this debt-to-capital problem is you have growth, and that's not going to be enough. And you have inflation, which every central banker wants and is trying to produce. And if that doesn't work, you got write-offs. Nobody's talking about the write-offs, but there's no way this country can meet the promises it's made to its people. And sooner or later, somebody's going to have to make that announcement. We've tried growth. We don't have enough. We've tried inflation. We couldn't get it going. Guys, we can't meet the promises of Medicare that we've made to you.
Wow.
I wouldn't want to be that president.
Be careful what you wish for.
All right.
Well, Bill, thank you. And your book, Free Cash Flow and Shareholder Yield, encapsulates your basic principles. Still on sale, right?
Still on sale, right.
Terrific. Thank you.
Thank you very much.